Hello, everybody. Welcome. We'll just give it a minute or so for everyone to get into the room. Okay, I think we can go ahead and get started. Welcome, everyone, to our first webinar in our retro GASB series, GASB 65, items previously reported as assets and liabilities. We're happy to have you here with us today. Before I introduce our presenter, a few housekeeping items. This webinar is being recorded, so be on the lookout later today for an email containing a link to the recording, as well as a copy of the slides and other resources. This webinar will run 50 minutes with a 10-minute Q&A immediately following. If you have any questions for our speaker, please put them in the Q&A box located in the Zoom toolbar. To find that, hover your mouse over the top or bottom of your screen and a toolbar will pop up. This webinar is eligible for 1 hour of CPE credit. We'll launch 4 polls throughout the presentation. To receive credit, you must answer 3 of the 4 polls and also complete the short evaluation you will receive afterwards. LSL is using a new CPE system, so please note that the evaluation email will be coming from LC Vista, and please allow up to 1 week to receive this email. If you're having trouble seeing the polls, try minimizing the Zoom screen as sometimes the poll question pops up behind it. You may need to click and drag the Zoom screen around to see it. And if you're using multiple screens, check each one as it may pop up on another screen. If that doesn't work, you may need to disable your pop-ups. Now, I'd like to introduce our presenter. Stephen Berrett Warnick is a senior manager in LSL's Assurance and Advisory Department with nearly 2 decades of experience serving California's state and local governments and nonprofits. From preparing ACFRs and navigating complex compliance audits under uniform guidance to implementing the latest GASB standards, Berrett thrives on solving challenges that matter. He helps agencies translate technical audit requirements into practical, actionable strategies, improving processes, enhancing transparency, and ensuring smooth, confident audit preparation. Also, we've asked Ryan Domino, partner in our assurance and advisory department, to help monitor the Q&A throughout today's webinar. So feel free to submit your questions as they come up, and Ryan will answer as many as possible during the presentation. Okay, Barrett, take it away.
Great. Thank you. We appreciate everyone being here today. This morning, I know that your time is very valuable, so we do appreciate you joining us. We maybe just to kick us off a little bit, we want to talk, as you probably noticed, we're calling this our retro GASB series, and to just fill you in a little bit on what that is and why we're doing this. Really, if if you've been around for a little while, you've seen GASB standards as they've kind of proliferated over time. I know that most of us are probably familiar with GASB 34. GASB 34, of course, was kind of a sea change for everybody, and that happened, just to date us all. That happened back in 1999, just before the year 2000. And presently, you're probably well aware, we're up to, last year was GASB 101, which was very fun. This year we're working on GASB 103. And so these standards have kind of marched on over the years. And as they've done so, of course, you guys are probably also familiar, GASB's released what they call the codification. They've kind of tried to flatten this history somewhat and to make it a little bit more accessible, but really in some ways it's very valuable to understand historically how things evolved in these standards. And so our hope is that as we go through this series this year or over the next several months, we're helping you to develop some background understanding and history into how some of these standards came along. I'm sure we're all probably experts now on compensated absences after going through GASB 101. But if we miss some of these older standards as they came out, we might not have had the opportunity to deep dive into them as much. And so we're doing this retro GASB series kind of in hopes of helping to sort of develop that history, develop that genealogy, if you will, of these different standards, and with that, create kind of a better understanding and a deeper comprehension of what's actually happening in the ACFR and in governmental accounting. So I will say, right out of the gate, this today we're doing GASB 65. And GASB 65 is really the standard that put deferred outflows and deferred inflows on our balance sheets. And it's kind of an esoteric a standard. It's sort of a tough standard. And so this one, hopefully it doesn't, I can keep it from being too dry. But if you can survive this one, I think it's going to be probably smooth sailing from here on out. This might be one of the tougher topics that we tackle together. But I think this is also a very important topic. Honestly, as an auditor working with governments, with cities, counties, districts, one of our key risk areas is always these deferred inflows and outflows, and partially because they really are kind of complex and nuanced. So with that, we're going to try to help you understand these a little bit more. I think that when we're done here, you'll probably still be scratching your head a little bit, maybe, and going, I don't know that I completely understand it all yet, but hopefully you'll understand much more. This, as mentioned, this is a tough area. But appreciate you hanging in here with us and joining us. Is to start this off, as we talk about deferred inflows and deferred outflows, on a kind of day to day, the most common instances of deferred inflows and outflows that we run into just on a practical basis are really going to be unavailable revenues. Primarily unavailable revenues, you see it frequently, and then the other place that you see it very frequently is related to your pension or OPEB liabilities associated with those. There's usually some deferred inflows or outflows. Some of you may have deferred inflows or outflows kind of recorded on your balance sheets related to debt refinancing, which happens less frequently, of course. That's every so many years. If you're a very large or busy entity, maybe it happens more frequently. But with that, being said, just practically speaking, those are the areas where we see it the most frequently. And honestly, the one that really stands out is probably unavailable revenue. So as we have this conversation today, I'm probably going to approach this from a couple of angles. I think so. First angle, I'm just going to kind of help us understand unavailable revenue a little bit, and along with that, we're going to just generally talk about accruals and do just a little bit of a refresher just on the different bases of accounting being used in the government arena. And then after we kind of move through that and just talk practically about that and year-end accruals, I'm going to move into GASB 65 a little bit more conceptually and formally, and talk about that standard and some of the impacts that it had on debt and some of those things that are probably a little bit less frequent. But so maybe to start off with, we want to just talk a little bit about this word bases. So and when governments use multiple bases, and let me advance my slide here. I joke around with people. You guys probably have too. I know that for myself, when I graduated from college and I landed my first accounting job in governmental accounting back in I think 2007. I remember thinking, after I'd been there for a couple weeks, this is not the accounting I learned in college. I was a little bit discouraged because I thought this is different than I think what I'd seen before. And I joke with people now, and I tell them, honestly, governmental accounting is, and I know for all of us that are in governmental accounting, it sounds like we're tooting our own horn, but it is very complex, and it is more complex than your typical financial accounting in a lot of ways. I used to joke with people that governmental accounting, normal accounting is three-dimensional accounting. Governmental accounting in some ways is like four-dimensional accounting. And I think that that's a true statement. And so there's a lot to understand. And as you all know, that can be a very difficult thing to manage as you're hiring and training staff and trying to help them get the nuances. But so just as a general refresher, governments, they have included in the ACFR. The ACFR is very complex, as you all probably know as well. The ACFR is a thicker document than most other financial statements. Most financial statements, and for a private entity, excluding the SEC, but for just private companies, usually we're looking at 40, 50 pages. ACFRs commonly are between 150 and 250 pages, and so there's a great deal of information that's included in there. And part of that is because something that's unique about governments is that governments present their financial statements kind of we use this word basis, under different bases of accounting. So different measurement focuses, they kind of recast it. And so as you probably know, or maybe not, and if you look at an ACFR is kind of broken up between what we call the government-wide statements. And then following that are what we refer to as the fund statements. And the fund statements, that's really where the four-dimensional accounting comes into play. Is that the fund statements are where we break out the government into many different entities, and within those entities, they each have their own set of books, really. And so just talking about that briefly and reviewing with you kind of high level before we get into these accruals. The reason for that is governments are focused on something very different than for-profit companies, as you're probably aware. In a for-profit company, we're very concerned about the economics. We're very concerned about profits. We're very concerned about dollars. Everybody wants to know if a for-profit company is an engine that can produce money. Instead of producing energy, it's producing money, and they want to measure that and see how efficiently that can happen. With the government, the story's a little bit different. Governments, because they're receiving money from people in what we refer to lovingly as non-exchange transactions. That's the accounting version of taxation's theft, right? So they're non-exchange transactions. So governments are able to, because they receive this funding, governments have a special stewardship and a special accountability that they have to keep in mind. And really, the financial statements of a government are designed for the taxpayers, for their constituents, to be able to measure, as you see here on the slide, operational accountability. And you guys are probably all very aware of that. The public's very concerned with what's happening financially in your entity, and the financial statements are really designed to cover that. And with that idea, we say there's a different measurement focus for government. Government's measurement focus is really it's on accountability and the efficiency of their operations, and a for-profit company is very focused on the production of money. Along with that, as you guys also probably know, and you probably spent half your year worried about getting your financial statements completed, and then just as soon as you have that done, you get to spend the other half of your year worrying about the budget, right? So in your job, there's really kind of two focuses for financial purposes that are very critical. The budgetary process is honestly, in some ways, is the financial process most people care about, probably within your jurisdictions. But because of that, the financial statements for governments are very focused on that budgetary measurement focus. And the idea there is that they want to know what dollars are going to be available to spend next year for programs, for the things that the government needs to do, or that your district needs to do. And with that in mind, it's very budgetary focused. And so we have this concept here called the current financial resources measurement focus. And that's really where governments depart from the for-profit world significantly. They're very focused on knowing, hey, what can we actually use in the budget in the coming year? And with that in mind, they don't want to sneak anything in there that will give someone the impression that they can spend more than is really available. So as we mentioned, the current financial resources measurement focus, they want to know what's actually going to be spendable in next year's budget. Government accounting is very focused on that. And that's kind of a key concept for us as we're starting to talk about, and you're probably a little bit lost and wondering, okay, wait, we thought this was about GASB 65, but just to lay a foundation and to help us understand deferred inflows and deferred outflows, you also kind of need to understand this idea of the current financial resources measurement focus, particularly as we start to talk about unavailable revenue. I don't love this chart. I might kind of skip past it, but as we talk about measurement focus, sometimes we say on one end of the spectrum there's the cash basis of accounting, and on the other end of the spectrum there's the accrual basis of accounting. Government really kind of lands in between those two, and it's a little bit unique in that sense. Um, I'm going to pass through some of these that might not be quite as critical. We've already talked some about how the budget plays into this, and really the idea of the modified cash basis is what allows for accurate budgets, kind of moving forward. Um, Accrual basis accounting, and maybe we can. I think that we might have a polling question here that we can toss in. Just you guys can answer yourselves if you're working with staff and you have a year-end close. The question is, does your staff struggle with accrual basis accounting at year-end? And you might be going, I'm not really sure what you mean by accrual basis accounting, but what we're really referring to is, do they struggle with recording accounts payable and accounts receivable and figuring out what those are at year end? And and that can be a little bit tricky if that's always sometimes that's something that you may understand, but your staff may not fully understand. And so we see jurisdictions wrestle with that a lot. And as we talk a little bit about these bases of accounting and the modified accrual basis, that's where these things really come into play, and they get a little bit it gets a little bit sticky. So with the modified accrual basis, of course, the other kind of concept that we want to throw out here is that it's only applicable to governmental funds. And governmental funds really are these funds that do have budgets. So in your in your financial statements, you of course you have your government-wide statements at the front, and those are full accrual always. Then you also have proprietary funds or enterprise funds, and those are usually full accrual also, so pretty simple. But then when you present your governmental funds, those are going to be on the modified accrual basis, because those all are very budget focused, and they have to do with kind of the spending of tax revenues, or what we call non-exchange revenues, things that are kind of non-reciprocal in nature, so there's a greater level of accountability. This is certainly your general fund. Your general fund is going to be a modified accrual. Any of your special revenue funds. So just really quickly, as we talk about this kind of this measurement focus, and we start to kind of move into accruals and unearned revenue or unavailable revenue, as we might say. Just an example here is, on a modified accrual basis, in a governmental fund, you might in one year collect $1 million, or you have a tax roll of $1 million, let's say, just for as an example. So you've extended the tax roll. You know that there's $1 million that should be collected. As you're making these collections throughout the year, by June 30th at year end, you've collected 920 of this million, right? And so you've got an additional 80 that's still out there. And so in a modified accrual scenario, we would kind of ask, what happens to this 80? It might be reasonable to say, the entire 80 needs to be shown as a receivable. and recorded as revenue as well. The full million maybe should be reflected. Under modified accrual, they actually came along and said, you know what, because we're focused on the budget, we don't want anyone to think that we've got this full $1 million to spend. Um, and so they said, we're going to create a window at the end of the year, or a collection period, this collection window at the end of the year. And that's a collection window for receivables. And so you know that you have 80,000 in receivables at the end of the year end. You've collected 920, you've got 80 left. Now you need to also apply this concept and layer over top of that this idea of there being this window for the collection of that. Just by statute, governmental entities are told that they have 60 days, or kind of within the standards, they have 60 days beyond year end to recognize revenue under the modified accrual basis for taxes. And that's kind of a base concept that I think many of you probably understand. There's a window at the end of the year. So first off, you have to understand accruals and understand that, hey, if you have an amount that's due, but you haven't collected it all by the end of the year. So if $1 million's due and you've only collected 920, you have a receivable on your hands, right? You're still expecting to receive another 80, and it's due to you, and so it's valid to record that receivable. That's understanding just the basic accruals associated with this, and then but then to go even further for the modified accrual measurement focus, we need to ask ourselves if that funding, if that receivable is also available. And that's where this window comes into play. And so established by standard is this 60-day window in which you have time to collect this tax and record it. If it's recorded beyond or received beyond the 60-day window, it's what we call unavailable revenue. And unavailable revenue signifies that it's not available to spend. And again, kind of harkening back to this current financial resources measurement focus, the budget. Is this something that can be spent in the budget? And we don't want to miscommunicate to the board and let them know that, hey, we've got $1 million to spend, when in fact we really only have 980,000. And so that's where this unavailable revenue kind of came into being. And I know that's probably some of you might be rather confused with that. Some of you might already sort of understand it. As we talk, the karate analogy here. I think basic accruals are probably like your brown belt or your green belt. As we start to talk about these deferred inflows and deferred outflows and unavailable revenue, we're kind of moving into more black belt territory. But again, these are very important because these are required by GASB and by standards to be reflected in your financial statements correctly. And also important because they convey information to the users of the financial statements about what's able to be used or spent. So let's keep moving here because I'm probably putting you guys to sleep. And maybe just refresh really quickly. Modified accrual, the way that it treats expenditures is unique as well. It almost treats them on a cash basis. And so if you just, I'll kind of gloss over this, but if you buy a fixed asset, the full cost of that fixed asset hits your statement of activities or your income statement in the current year. In the private sector, that never happens. We capitalize it, under full accrual, and it doesn't run through there. But that does happen under modified accrual, so that's a little bit unique. Likewise, debt. If you issue debt, the entirety of that cash received from the debt would be, or the entirety of the proceeds gets recorded as current period income. So that's unique in modified accrual too, but helpful again under the budgetary basis. It helps people know how things are kind of happening or to be reflected within the budgets. So we'll keep moving here, and maybe now we'll sort of dive in a little bit more deeply to GASB 65 itself. I've probably bored you to death with discussing these bases of accounting and modified and that type of thing. But as you know, if you do have staff, this can be a very complex thing to sort of explain to them. It's hard enough, as mentioned, just on the base level, the green belt, understanding how AP and AR work and basic year-end accruals work. But then if you also have to then explain to your staff that you have to layer another concept on top of that and understand the availability period related to revenue, that kind of takes it a step further. And so as you're evaluating receivables at year end, you need to make sure that you capture everything that is really an accrual, and then you need to go back through those receivables and parse out from them the things that were received within that availability window and the things that were not. And then to add to it just a little bit more, that availability window has some nuance to it, as you probably know. And I would challenge you, if you don't know off the top of your head, you might, but I would challenge you to go have a look at the financial statements for your entity. I think usually in the very first note of the financial statements or the second one, depending upon where it is, there's the summary of significant accounting policies. And contained in there, you'll find paragraphs about revenue specifically and maybe tax revenue. And it should state what your availability period is for both tax revenue and other types of revenue. Some the tax revenue by standard is 60 days. Always. But for other sources of revenue, there's some discretion there. And so your particular entity might be using 6 months, might be using 3 months, might be using 60 days. If you aren't aware of what that availability period is for your specific entity, I would challenge you to go see what that window is. So you sort of know, what's the cutoff for unavailable revenue. So keep moving here. Let's see. So just we'll dive into GASB 65 then fully here. But to go back to the idea of this retro GASB series, as we're kind of hearkening back to GASB 65, maybe just to talk about the history there a little bit. As mentioned again, to just help you see the timeline, GASB 34 happened just before the year 2000. GASB 65 here was implemented in December of 2012. And so that was, a good decade beyond that. Prior to the release of GASB 65, and you will see this happen from time to time with the GASBs, just kind of a little history lesson, they released GASB 63. GASB 63 was really the standard that outlined the concept of deferred inflows and deferred outflows, and it changed sort of the balance sheet forever. With GASB 63, they said, "Hey, look, we're going to add these new categories to the balance sheet." It used to be that we just had assets and liabilities, right? But now there's some things that aren't assets and some things that aren't liabilities that we're going to put on the balance sheet. So in some ways, probably sounded a little bit revolutionary. It wasn't as exciting as it sounds, but it is kind of it's unique to think that the balance sheet used to be assets and liabilities and equity. In some ways, a balance sheet is just a pile of assets. You can almost think of it that way. And algebraically, you can say, look, these assets consist of things that belong to other people and things that belong to us, or things that have claims on them, or things that are free and clear and belong to us. And so that's kind of the concept of a balance sheet is you have all these assets, and it's just another way to describe what these assets consist of. And so it was unique for them to come along and say, okay, there's things on this balance sheet that aren't assets or liabilities. And so we want to talk about that a little bit. That's where things can get a little bit confusing. And in some ways, it might be beneficial to not think too hard about it. You might just end up confusing yourself. But as you look at the balance sheet now, you'll see that there's clearly an asset section. And then down at the bottom of that asset section, you can see there's a section for deferred outflows of resources. Then there's a liability section. And below the liability section, there's a separate breakout of deferred inflows. And if you're like me, I hope that words describe well what the concept that they're labeling. as I, initially had a look and saw deferred outflows of resources, I was very confused. I thought that sounds very abstract. I don't know what that means. Deferred outflows of resources. Deferred, of course, in my mind, means there's a timing issue, right? But then when I got to outflow, I thought outflow of what? Outflow of resources, and that's where things get really abstract and can get a little bit confusing. Um, we want to talk just a little bit about the definition of an asset and the definition of a liability. And some of this gets so basic that it's almost painful. It'll make your eyes cross. Here's one more polling question for us really quickly. Date us all. So if any of you are old like me, this will hurt your midlife crisis a little bit. But do you remember when GASB 65 was released? How far back do you go? Um, so GASB 65, it's interesting with all these accounting standards when we talk about why were they developed. Uh, what they always say just about, I say that sort of jokingly, is that they enhance the consistency and the clarity of the financial statements. That's really what they're always trying to do is they're trying to make sure that the financial measures that everyone is using line up. And so, of course, it becomes easier to compare and contrast different entities and to make decisions based on that. But in some ways, it was GASB 65 was kind of a cleanup standard. As I mentioned, that just prior to GASB 65, they released GASB 63, and GASB 63 was the initial introduction of deferred inflows, deferred out. They said, hey, look, we're now going to have deferred inflows and deferred outflows, and it's going to change your balance sheet forever. And I think it probably kind of blew everybody's mind, and they were like, "Wow, this sounds groundbreaking." And then everybody was really confused, and they didn't fully understand what that meant. So shortly thereafter, they released GASB 65 as a cleanup standard to help clarify just what that did mean, and make sure that it wasn't the Wild West. Um, so the idea behind GASB 65 or deferred inflows or deferred outflows, there's probably a couple layers to this and a couple ways we can approach it to wrap our heads around it. I think initially in the private sector under FASB did something kind of similar to this. Although different, there's some nuances that are different. But if you're familiar with the private sector came up with this concept of other comprehensive income. Sometimes we call it AOCI. And really, what they were doing is they realized that if a company has investments and those investments are on the balance sheet, the value of those investments changes over time. And this might be kind of a key concept for us here as we wrap our heads around this. So as a company has investments, those investments are on the balance sheet, but their value changes over time. And so it's always been kind of a conundrum to determine how do we reflect that in the financial statements? How do we reflect that change? And what they sort of boiled it down to is they said, look, you've got these assets on your balance sheet, and maybe they've always been there. And so you're not really changing you're not adding or removing any assets. You're just changing the measurement of those assets. And so I think that's kind of a key concept that I want to throw out there is they're changing the measurement of of those assets. So the value of those assets, the same assets sit on the balance sheet from year to year, but their value changes or the measure of that value changes. And so what they felt like, hey, if what's changing is really just the measurement, that should be kind of in a category on its own. You're not receiving any new assets, and you're also not receiving any new obligations or liabilities. You're just remeasuring things that are already sitting there. And so with that, they said we want to carve that out and have that stand separately as what we call unrealized gains or losses. Unrealized gains or losses. And they, philosophically, they said this shouldn't be part of net income. This is not part of current year operations. It skews things. If we're to let this land in current year operations, it's going to skew things, and the users of the finance, your boards, the people looking at these financials are going to be very confused, and it's going to kind of dilute the value. And so with that, they came up with this concept of other comprehensive income, and they said, we're going to carve this out and move it. Um, I mentioned that because GASB did something similar. As you know, GASB often follows FASB. GASB did something similar. They changed. They didn't put it below net income, but they kind of said, okay, we've got some similar concepts. We have some things where we're really just remeasuring. We're remeasuring things that sit on the balance sheet. Nobody's acquiring any new assets. Nobody's incurring any new liabilities. We're just remeasuring ones that already exist. And they said, when we have those remeasurements, we've got to find a way to put them on the financial statements in some ways. And also, and if we do it in one year, it could skew things. So kind of some basic concepts there. Just something to remember is there's remeasurement, and really the spirit behind this rule, or the spirit of this law, is that they don't want that remeasurement to skew your income statement. They don't want people to, because you're, in some ways, your income statement is like your scorecard, right? The people that are using the financial statements, that it's kind of like watching the game reel at the end of the football game and saying, okay, look, we want to see, we know what happened, we know what the final score was. That's your balance sheet. But we want to know how that came to be, during the game. What happened during the game that created this balance at the end of the game that said these are the winners, these are the losers, and so but they say if we include some of these remeasurements, it skews that scorecard, and so they did not want to do that. So GASB 65 came along. It of course it enhances financial reporting quality. They all do, right? But let's talk just a little bit nuts and bolts here. If you guys are all still awake, if you're not, I encourage you to caffeine up a little bit. I know this is sort of a tough one, but so is we just talk about the definition of an asset. Really, what happened with GASB 65? Another way to put it is they came along and they said, "Hey, look, we have things in assets and things in liabilities that aren't really assets or liabilities. We've parked them there because practically, if you have a credit, you need a debit, and we want to spread these things out over time. But to the PhDs on GASB, they said this doesn't really meet the definition of an asset, or it doesn't really meet the definition of a liability. So let's talk for just 1 second. And I think if I was to ask each of you, tell me what an asset is. It's an interesting question, because you probably all would clearly, and I would believe you'd go, I know exactly what an asset is. But sometimes to put it into words is a little bit difficult. And we get so nuanced about what an asset is that it's probably hard for us to verbally state it sometimes. But and it is a little bit fuzzy, right? But honestly, that is kind of what we do day to day as accountants, right? We're constantly trying to define and record and value assets. But maybe what we want to talk a little bit about is just that definition of an asset. Let me see if I can find my definition here. So let me read this to you. And again, some of this is accountant speak, some of it's abstract. But so an asset is essentially a resource with a present service capacity. And of course, in accounting, that's where things always get complicated, right? It's a resource with a present service capacity that the government presently controls. Just a silly analogy to kind of help you think about that. I think of a squirt gun, which again, very silly. But so a squirt gun is full of water, right? It has a capacity. It's got a certain amount of water in it. And if it's half full of water, you're able to control that squirt gun and spray the water to a certain degree. And so in some ways, that's what an asset is. An asset's something. If you think about cash, cash has a capacity. You can do. It's a resource. It's a benefit to you, and there's something you can do with it in the future. Um, and again, that concept of control is important too. You actually control that asset? A liability liability. Let me read the definition of a liability. A liability is really a present obligation to sacrifice resources. So it's a claim on those resources that you don't have any discretion to avoid. And we're being abstract and complex here. And again, you guys probably all perfectly understand what an asset is and what a liability is. But GASB, as they came along for GASB 65, they looked at these definitions very strictly. And as they looked at these definitions, they said, some of these things that we are grouping with assets don't meet this definition. And really, what we probably want to focus on is we're talking about not meeting that definition is this idea of present service capacity. So assets have a present service capacity that can be controlled. Um, and they said, some of these things don't have a present service capacity. Likewise, with the liability, I think that they said some of these liabilities don't. There's no remaining obligation, and I'll get to that just a little bit more here in a second. But that's kind of the hinge issue or the hinge criterion that we're talking about is that as they looked at these, they said, hey, look, we've got things grouped here in assets that really don't have a present service capacity. So your squirt gun's already empty. So you can't use it in the future. It doesn't have any capacity left. Or likewise, it doesn't have, there's no present obligation. There's no remaining future thing that needs to be fulfilled. It's already done. And so with that in mind, they said, okay, these things, again, esoterically, these things don't quite meet the definition of assets and liabilities. We want to show them separately so nobody gets confused. I think part of the issue is they don't want to be communicating uh, again under the budgetary concept. They don't want to use the financial statements to think that they've got more resources available for use than they actually do. And maybe some of you have had that experience. For myself, I know that there's times where I've met with boards, and sometimes boards can be very confused as they look at the balance sheet to know, what can I actually spend? Honestly, that's probably the most important question for them. What can we actually spend? What here is actually spendable? And so, in that spirit, GASB came along and said, okay, look, we need to separate some of these things out and treat them differently so nobody's confused and thinks that these things are things that can be spent, or likewise they think that these are things that are going to require resources in the next year from the budget, because they don't. And so let's get into some of those a little bit more just to talk about what those things specifically are. Let me cruise along here. As GASB 65 came along, they parsed out things from that were previously assets or liabilities, and they moved them into deferred inflows or outflows, or in some cases they just went ahead and expensed them entirely. I think we have one more polling question here. And again, this is just harkening back to this is a little bit of a trick question. We'll talk about this in just a second, but deferred inflows, outflows. If usually for yourselves on your balance sheet, you're more familiar with it as unavailable revenue, pension or OPEB, or maybe debt refinancing. But again, so jumping back to as GASB 65, where this really started to bother people as they were looking at the asset section of the balance sheet, they often saw things capitalized related to debt that they felt like did not belong there. And again, this can be tough if if you're in a larger county or city, you might deal with a lot of debt, and so you might be very familiar with debt issues or problems and the accounting for debt. If not, you might just deal with recording debt every 5 years or every 12 years, so not very frequently. But what we kind of saw was as people issued debt. There's always the question of what do we do? Normally you know what the principal amount is. but then you have a bunch of peripheral costs that kind of go with that debt. And you're always kind of wondering, what do we do with that? Does that get capitalized? Is that part of the principal? Does it get expensed? How do we treat that? Is it interest? And I think what GASB saw was that it was being treated very differently in different places. It was the Wild West a little bit, and so debt issuance cost is kind of the beginning, the starting point of this idea. And specifically, as once you have, as you have debt, uh, really what goes, you sort of have the three buckets related to debt. You have the principal, as mentioned, the actual, face value of the debt, and then you also have um, these issuance costs that are associated with it. And then I guess maybe this is more appropriate to say when you're refinancing debt, you really have three buckets. So you have these debt issuance costs. So you have the actual principal amount, you have the actual issuance costs. If you refinance debt, you also end up with this difference between the refinancing. As we all know, you really only refinance a debt if it's going to help you, right? Normally, that's the idea is that you might have an outstanding debt for $1 million. Maybe it's at 6% interest. If you can refinance it at 4% interest, that change in the interest is going to save you a lot of money over time. And so that savings is what we refer to as refunding gain or loss. So refunding gain or loss. So people are motivated to refinance because it helps them out over the long term. And that turns into a gain or loss. So GASB said, look, when you're refinancing debt, there's really kind of three buckets. There's of course the principal, the face value that's on that debt, and then there's the refine or the debt service costs, or sorry, not debt service costs, the debt issuance costs. So there's just the cost, the paperwork to pay somebody to put all that together, to pay the bankers, and then there's this gain or loss. So what is actually going to come, the difference between your old debt and the difference between your new debt. And they said all three of those things need to be kind of treated differently. And in specific, when you're looking at the gain or loss on a debt, again, we're going to jump back to, as mentioned before, and I keep trying to repeat this word, it remeasures the value of that liability. So the GASB said that really what's happening is you have a liability that's been on the books for years, and you're doing something with it to remeasure that value. A lot like you'd remeasure the value of an investment. So the investment's value changes over time. So they're saying there's this remeasurement of the debt. That remeasurement isn't really an asset. It doesn't have any presence. Normally, what we would do is, with that remeasurement, if it helps you, or sorry, if there's costs related to it, we capitalize it, right, and we put it on the balance sheet. But they said that there's really no asset there. That's something that's already happened, and you think that it shouldn't be recognized in one period, but there's no control over that in the future. And because of it, we want to park it in this special category that we would call deferred outflows. So it's something that's already been paid. The resources have already flown. They've already left. But it's not something that we want to recognize all in the current period. Under again the current financial measurement resource focus, because we're focused on budgets. We don't want anybody to get confused and think that this is an asset that they can spend, because it's not. It's really just a method to smooth scorecards in the future. And so that's the way that they treated this debt. And that's really sort of what gave rise primarily to GASB 65 was realizing that everybody was recording their debts differently. And somebody finally coming along and saying, look, this is how you need to treat debt. And when you have a refinancing, there's really sort of three buckets. There's your principal. There's the debt issuance costs, or what you're paying the bankers just to do it. And they said that's a period cost. That's a current period cost that comes from the decision you made to enter that transaction. And then there's the gain or the loss on the refunding of the debt. And they're saying that is where it becomes, depending on whether it's a gain or a loss, it becomes a deferred inflow or a deferred outflow. And then they say that we want you to spread that over the remaining life of the debt, so it doesn't skew things. Um, Again, we're running a little bit short on time here, so I'll kind of move fast. But as we mentioned, impact on the financial statements. One of the key things is GASB 63 came out. They actually changed the label. It used to be uh, net assets. The very bottom of your balance sheet, you have net assets, and that changed to net position. Of course, kind of symbolizing that you have things that are more than, it's not just a lump of assets. You have these new categories that aren't assets or liabilities. So you have a net financial position at the end. Just kind of mention that. Something else that's also very key or important is maybe as we discuss. Let's jump to this last polling question quickly, and then we'll talk here about kind of the word deferred. Um, if throughout my audit career, the word deferred has caused a lot of heartache. I think deferred is a word that gets used in several places. As GASB 65 came out, one of the things they did was they said, "Hey, thou shalt not use the word deferred anymore unless it's with deferred inflows or deferred outflows. That's the only time we should be using the word deferred. Deferred inflows or deferred outflows. Previously, um, we use this term deferred revenue, and deferred revenue was very confusing for people. Deferred revenue, in some cases, meant unavailable revenue that we've been talking about now. So revenue that comes after that window. But in other cases, it refers to when you get an advance or somebody gives you cash up front and you haven't earned it yet. So we used to kind of use the word deferred revenue interchangeably for both of those things, and they're two very different things. So GASB 65, one of the things that they did was they said, "Thou shalt not use the word deferred anymore." Unless you're using it in conjunction with deferred inflows or deferred outflows. And likewise, so deferred inflows are really just unavailable revenue. Unavailable revenue is a deferred inflow. That other category that we used to call deferred revenue is really something that we want to label as unearned revenue. So unearned revenue means somebody's giving you cash, but you haven't done what they're paying you for. And so that's probably an important thing to pull out here too. And we might be running a little bit short on time. I don't know if we have any specific questions on any of this. I know some of this is, again, these are kind of some of the more esoteric issues with GASBs. And as mentioned, if you can get through this one, the rest, you're downhill from here. Everything else is going to be a little bit easier. But we wanted to go over this one in specific just because there's a lot of risk in financial. Honestly, most of the issues that I've had with financial statements over the last decade have been in some way related to these specific concepts, to understanding accruals and then being able to label or to layer on top of it the concept of availability. And then again, not confusing those things, not confusing deferred revenues, not mixing unearned revenues with unavailable revenues. Um, so I think that those are probably our key items. Just as happy to entertain any questions that anybody might have. You guys are probably dying to go get some more coffee right about now. And just quickly too, kind of before we do questions or break, we're going to continue to have this retro GASB series. The one that's coming up on the 20th is maybe the most important one. Is I mentioned before, GASB 34 was really kind of the watershed that defined governmental accounting for us. And so if you could only pick one, I would probably encourage you to go to that one. But these other ones will be great as well. As you can see, we've got several dates coming up. It's all beneficial. Again, as mentioned, you probably are going to be leaving this and going, I still don't fully understand deferred inflows or outflows, but hopefully you understand them a little bit better. And again, if we have any questions, happy to entertain them. But if not, we can. I think we've probably met our time. Is that right, Rachel?
Yeah, it looks like Ryan handled a lot of the questions in the Q&A box, so there aren't any open ones at this time. But thank you, Barrett, for a great presentation, and thank you everyone for being here. As a reminder, you will receive an email with the recording and the slides later today, so be on the lookout for that. And have a great day.
Thank you.